everyone who's joined. For those of you who don't know me, my name is Sapna Shah. I am the founder of RetailX series, and these used to be in person and now they're virtual weekly. Welcome if this is your first time. If you're returning, welcome back. Like I said, please keep yourself on mute. As we will go through the discussion today, we'll have kind of the first half will be a moderated discussion between me and Nico about equity crowdfunding, and then we will get to your questions. So if you have questions, please put them in the chat. You can do that throughout or towards the end. We should have time for plenty of questions. This call is also being recorded and it will be posted on the on the RetailX series YouTube page, so you can access it later if you can't stay for the whole time or whatever that might be. So with no further ado, welcome Nico. Why don't you introduce yourself and SeedInvest?
Got it. Well, thank you so much for having me this afternoon. Really appreciate the opportunity to talk to everybody and answer some questions. The quick 15 seconds on myself. So my name is Nico Leeper. I'm on the venture team at SeedInvest, which is an equity crowdfunding platform with a community of about 300,000 investors investing in seed through series seed stage companies. And to date, we've worked with a little bit over 200 companies that are currently in our portfolio.
Great, perfect. I'm excited to have this conversation. I know a lot of founders on the call have had a lot of questions about equity crowdfunding. So let's kind of kick it off by, can you tell us a little bit about how equity crowdfunding works in general? How is it specifically different than raising a round from angels or from VCs or a friends and family round?
Yeah, absolutely. So equity crowdfunding kind of got its start out of the 2012 Jobs Act, which essentially brought capital formation to the 21st century. So until then, the traditional fundraising process was very old school, kind of boots on the ground, pounding the pavement at Sand Hill Row, in-person meetings, kind of angel groups, very closed off networks. So really difficult to fundraise. If you weren't in Silicon Valley, New York, or Boston, there really weren't that many options for founders to raise capital. So I think probably the biggest difference between the traditional process and equity crowdfunding is the ability to cast a wider net and do it online. So rather than having to go and sit down and meet individually with 10 different firms or pitch 10 different angel groups, essentially you can do so in a scalable fashion online. I think that's probably the biggest difference between the offline process and the online process is simply the fact that you can do it in a scalable manner and reach a large audience of investors in a time-efficient manner.
And who are those investors that are on platforms like SeedInvest?
Yeah, so the way that we look at investors that leverage equity crowdfunding to invest in startups, they're essentially falling into two buckets. On the one hand, a lot of those investors and the investors that are oftentimes the most active in cutting the largest checks are accredited investors. So those are people that historically have been able to be LPs and venture capital funds. These are people that have been able to join angel groups. So we still see them as being a huge driver of online investments via equity crowdfunding. So again, it's going out to oftentimes kind of very similar people that were part of the funding ecosystem prior to equity crowdfunding, but just on a much larger scale. So for example, you might have an angel investor in Kansas City, where there aren't that many startups, they don't have that many opportunities. But if that investor leverages equity crowdfunding, they can invest in startups, across the country and honestly, across the world. So those will be high net worth individuals, angel investors, family offices. We actually see a few VC funds out there that leverage equity crowdfunding as a way to source those investments. So that's kind of the first bucket of investors that leverage equity crowdfunding. And those were honestly the first people that were able to do so. Starting in 2015, we were able to open up startup investing to basically everybody else. So we kind of think of those individuals as retail investors. So someone that, these individuals will typically be, professionals, well off. They don't necessarily have the personal financial resources to be considered accredited. So we call them retail investors. So that's your normal everyday professionals that are looking to diversify their current investment portfolios into alternatives like startup investments.
Got it. That's really helpful. Okay. So you talked a little bit about, this is really an online platform and as a way to scale your fundraising if you're a company, but what sorts of businesses and at what stages of startups does equity crowdfunding really make sense for? Whether that's round size or industry or, type of business.
Yeah, so I think there's a couple different factors that we look at when talking to Oh, can y'all hear me?
Yeah, you're kind of cutting in a little bit, cutting in and out a little bit, but I can hear you now.
Okay.
Oh,
got it. If it gets bad, let me know and I can try to move my computer to a wire connection.
Okay. Oh, the joys of doing these by Zoom.
So when we yeah, I mean, taking a look at the kind of companies that we work with, we really do see equity crowdfunding as being industry agnostic. I think a big misconception is that this is only for consumer-facing businesses. Certainly, it is a model that works very well for consumer-facing businesses, particularly those that have passionate user bases that potentially want to, not just be kind of, brand evangelists, but actually have a stake in these companies that they love. But we also see this actually being incredibly popular with B2B businesses, which frankly was a little bit of a surprise to us when we first got started. But what we found is that, for the same reason that traditional investors love B2B businesses, crowd investors oftentimes are just as savvy. So even though they may be looking at an investment where they're never going to personally be a customer of that company, if they have compelling traction, if they have, a compelling business model, those companies can still resonate with investors. And we've actually seen those companies have some of the largest equity crowdfunding raises historically. As far as stage, I'd say that the earliest that this really makes sense for, in most cases, there are always exceptions. I'd say the earliest is seed stage. Because investors on equity crowdfunding platforms do have options, they're looking at multiple investments at the same time. So it is important for a company to have, certain kind of baseline metrics in place. Typically, what we look for is, at least a full-time team of at least 2. At the earliest, companies will need to have kind of an MVP in place. And then the third piece, and this is going to vary widely from company to company, is some sort of traction. Whether that's early revenue, whether that's strategic partnerships. We work with a lot of biotech companies where maybe they've gone through phase 1 clinical trials and they're gearing up for phase 2. So depending on what industry you're in, that traction will look a little bit different. And then the latest stage companies that we see leveraging equity crowdfunding, I'd probably say Series C. Under the equity crowdfunding regulations, you can actually raise up to $50 million from crowd investors. So it really does, equity crowdfunding actually can be a good solution for a wide range of companies when it comes to a stage perspective.
So, so if the max you can raise is $50 million, is there a minimum? I mean, especially if you're at seed, obviously you're not raising like $100,000, but is there a minimum size that you're looking for in terms of a raise?
Yeah, so legally there isn't a minimum amount. What I would say is there is a practical amount. Given some of the work that goes into putting on an equity crowdfunding campaign, given some of the costs that are incurred, I would say most companies should be looking to raise at least, in my opinion, $300,000 to $500,000 of an overall round via equity crowdfunding. If you're looking to raise less than that, probably doesn't make sense to go down this path from a time and a resource perspective. It would probably make more sense to do a friends and family round or go to a local angel group, if you're looking to raise those smaller amounts.
So what you just said was really interesting. So you said 300 to 500,000 of your total rounds. So do most companies let's talk about the seed stage, since most of the founders on this call are very early. At the seed stage, are most founders using equity crowdfunding for a certain portion of the raise and then going to VCs, angels, or whoever for the rest of the raise?
Yeah, I'd say in probably 90% of the cases, and 90% of the companies that we work with, equity crowdfunding is one piece of an overall round. We really don't view ourselves as competitive with VC. We really look at it in a lot of ways as complementary, because it's a very different value prop. When you're talking to a VC, oftentimes you're getting, a team that's going to be very hands-on with helping you run the business, helping you with hiring, helping you with the day-to-day. So it's a very different value prop than the crowd, which provides, I'd say, a different value prop. On the one hand, you have these, in often cases, kind of users that are now investors. So these smaller crowd investors can be almost super brand evangelists, where they're now very incentivized, from a bottom line perspective, to go out there and promote your company to their friends and their family and their network. We still do see some of that more traditional strategic value coming from the crowd. So, an example that I think of, we recently, or I guess now 2 years ago, worked with a company in the solar power space. They raised about $1.5 million from crowd investors, and they were taking check sizes as little as $500. So one of those $500 investors who, on paper really shouldn't have been that meaningful for them, ended up being someone that was in charge of purchasing solar systems for a large university system, and it ended up potentially being a large contract for them. So you still do see some of that traditional kind of strategic value add in the opening up of personal networks and adding their own professional expertise and background. But it is a little bit of a different value prop. So we do see it as complementary to VC. I'd say that, there's probably, for seed stage, there's probably two scenarios when we're working with outside investors where an equity crowdfunding platform would come in. Oftentimes, companies that we look at have maybe closed, call it 30 to 80% of their overall round. And for that last portion of the round that they're looking to close out, they don't want to necessarily, again, pound the pavement, have, numerous one-on-one meetings, go through 3-month-long diligence processes just to get a no. They want to get back to being founders, which is why people start a company. You don't start a company to be in fundraising mode 24/7. So oftentimes those companies will come to us and say, hey, this is kind of a scalable way where we can top off our rounds. I'd say the other frequent situation that we see with founders is they have a lot of their rounds soft circled. They've got commitments from other VCs, from angel groups, from maybe other strategic investors, but nobody is willing to essentially plant the flag on the ground and say, hey, this is going to be this is the valuation cap that we're going to put on your note, or this is the pre-money valuation. So oftentimes companies will come to SeedInvest or other equity crowdfunding platforms I've seen, and basically say, hey, let's leverage your expertise and leverage the data sets that you guys have on companies that you've worked with to price this round out. And then we can close those offline investors and also simultaneously raise from the crowd.
Yeah, that makes sense. That's very helpful kind of framework. So I think the next thing I want to talk about is kind of maybe you can walk us through kind of a step-by-step, like a how-to guide of how, if I were a founder coming in for the first time, like what would I do? How long does it take? What will the cap table end up looking like? What's the process? Which diligence is needed? All of those kind of like step-by-step things, if you could kind of walk us through it.
Absolutely. And I'll try to be as general as possible. Some of this will be a little bit more specific to SeedInvest, particularly on the diligence side, because we do take a highly vetted approach. There are other platforms out there that operate a little bit more like true platforms, so the diligence piece might not be as applicable to them. But I think for at least at SeedInvest's case, and I know a couple of the other better platforms out there, that begins with kind of a standard but I'd say accelerated diligence process. So most platforms will ask for a pitch deck. They'll ask for historical financials, projected financials, balance sheet, kind of this, pipelines, kind of the same thing that any other investor out there is going to be asking for to make an investment decision. And then what a lot of other platforms will also do, and I know this is something that we do at SeedInvest, is there'll be a handful of other questions that they're asking. Hey, what's last month's revenue, next 12 months projected, basically collecting a lot of data points that then on our back end, we run against a historic data set. So a lot of that work that at another firm might be done by an analyst just sitting there crunching numbers. Because of the massive data set that we have, I mean, we see thousands of companies every year, we're able to automate a lot of that. So it leads to faster turnaround time. So once we get that initial diligence materials, we'll follow up with a second round of legal diligence questions, as well as more high-level business diligence questions. And within a week, we can basically tell a company, yeah, let's move forward, or no, we're going to pass at this time. From there, you start to go down, I'd say for seed stage companies, two different routes. You can essentially go down a route where you're only going out to accredited investors, or you can go down a route where you're opening up your round to everybody. I'd say the benefits of going out to accredited only is that the process is a little bit faster, and there's a little bit less regulatory work and disclosure work to be done. The obviously downside is that you're going out to a smaller group of people, so you could potentially raise less capital. So if a company is going down the accredited investor only route, we most often see this when rounds are probably 80% full and we're just topping things off. Over the next, call it 3 to 4 weeks, a company will begin to onboard themselves onto whatever equity crowdfunding platform they're using. That process will look different from platform to platform, but typically it'll entail, building out a profile or a landing page that investors will be able to look at as they're making their investment decision. That'll have the team story, talk a little bit more about the company. We'll oftentimes have a deck. Sometimes we'll have a short video explaining the company, and then we'll oftentimes, also have a data room with additional materials. And then once that platform is built out, companies will also work with that platform's legal team to finalize offering docs, make any changes if necessary, and wrap up kind of housekeeping items, setting up escrow accounts, running bad actor checks. A lot of equity crowdfunding platforms are structured as broker-dealers, which basically means that there are additional diligence items that need to be done in order to protect investors. So it's a lot of checkbox stuff that gets done during that onboarding process. And then from there, a campaign will be launched. And depending on where you're doing it, that can last anywhere from 45 days to a few months. I know on SeedInvest, we target 45 to 60 days. We find that time frame is the most effective. If you're going down the path of opening up your round to both accredited and non-accredited investors, a lot of that stuff that you do for accredited only, it's the same thing. It's building out a profile, it's putting together a data room. That data room will oftentimes be a little bit more high level just because you're going out to a larger audience. So you might not include more sensitive materials, just given the nature of a public equity crowdfunding raise. The major differences will be for certain companies raising larger amounts, they'll get reviewed financials. Essentially think of that as a very light version of an audit. There's a lot of CPA firms out there that kind of specialize in doing reviewed financials for equity crowdfunding campaigns. We're partnered with several of them, and those can be fairly cost effective. Certain platforms will have companies kind of front those up front, kind of accounting and legal costs. Platforms like SeedInvest and a few others will actually cover those up front and only be reimbursed in the case of a successful raise. So getting the reviewed financials is a big piece. And then another big piece is if you're going to raise publicly at the seed stage, you need to file a document that's called a Form C. If you've ever taken a look at an S1 for companies that are having IPOs, it's similar to that. It's just a much skinny down version. Most of them only run 30 to 40 pages. Again, there are a lot of law firms out there that specialize in putting these together. There's one in particular that we've worked with in the past called CrowdCheck. If you're interested in kind of the nitty-gritty legal of equity crowdfunding, I definitely recommend that you check them out. They have a lot of great resources. At SeedInvest, we actually have our legal team internally build those for our founders. So depending on how you're doing it, it's either something that you'll take on yourself with outside counsel, or you'll work with the platform to get that Form C built out. And then from there, again, we launching 45 to 60-day campaigns. And what those campaigns look like, we kind of see a lot of these campaigns is essentially, having 3 legs of a stool. The first leg is the SeedInvest investor community. So we have, or whatever platform you're on. So platforms will have, typically several thousand investors that are already kind of their native users. These are people that are passionate about investing in startups, and they'll fill out a portion of this equity crowdfunding campaign. The second component is the founders community. And that varies in size based on kind of the stage of the company, based on their industry and whether they're B2B or B2C. So, certain companies will tap in for that piece. We'll tap into their user bases. So recently we worked with a company called Wink. They're a pretty large direct-to-consumer wine company. A lot of their round that they did with us was driven by their users and by their community. For other companies, particularly those that are B2B that don't necessarily have large communities, that'll play a much smaller role in how much is raised, but they're still able to go out to their personal network, their professional network, and invite people who might be interested in investing in them, but wouldn't be able to do so, either operationally or legally without an equity crowdfunding platform. And then the third piece of that equation, which again will kind of vary company by company as to how important it is really going out to the public. We have certain companies that we've worked with in the past that'll actually run digital ads to attract investors for their campaigns. So in a lot of ways, a lot of companies will almost treat equity crowdfunding campaigns for a portion of it as a product launch, where they're running digital ads, they're tracking ROI. So it can be a scalable way to raise capital, where you can say, hey, if I spend, I can spend $10, to acquire an investor who's going to make, a $500 investment, or whatever the numbers work out to be. You can, in a lot of ways, kind of take best practices from the digital marketing world and apply it to your fundraise, which is very different from how it's worked in the past. And then post fundraise, once things get wrapped up, a couple things. Our investors, and most platforms will require this, that investors be given quarterly updates. That's going to be very similar to the same updates that you're providing to any VCs or angel investors. For companies that open up their investment to the crowd and retail investors, there'll also be some additional ongoing reporting requirements. Essentially, it's an updated, basically 1 year, I believe it's by March 31st, the first fiscal year after you close your equity crowdfunding round. You essentially have to update that Form C and provide investors with an updated financial snapshot of how your company is doing. Depending on how you structure your round, so I know this is something that we do, you can actually have those legal reporting requirements terminated or suspended after your first year of reporting. And then I think the question that you had, and this is probably one of the most important questions, is what does this look like on your cap table? Because if you have, we have companies that we've worked with in the past where they literally had thousands of investors come in, and you can't have a cap table, with 1,000 individuals that each invested $1,000. That would be a little bit unwieldy. It'd be like herding cats. And most importantly, you could potentially trigger public reporting requirements. And, if you're a seed or a Series A or a Series B company, you don't need to essentially be acting, like someone that's traded on NASDAQ. So what we leverage is a trust structure where essentially all of the investors that come in under a certain dollar threshold have their shares custodied via that trust. So it's one line item on the cap table, one shareholder of record, so you don't accidentally trigger those ongoing public reporting requirements. So that's how it's been done to date. Recently, the SEC actually just a couple of weeks ago came out with a new ruling that's going to allow SPVs to be used for equity crowdfunding campaigns as well. Previously, you could only use SPVs if you were going down the accredited investor only route. So that will actually be another additional tool that founders will have as they figure out what's the best way to incorporate equity crowdfunding into the round, but keep the cap table clean.
That was a lot, and that was very helpful. So thank you. So it sounds like the same preparation that you're basically doing for a VC angel friends and family kind of raise is kind of the prep that you need, I guess, for equity crowdfunding as well. But I guess my question is there a different kind of metric of success? Like you talked about, particularly when you're raising from the crowd, leveraging your customers, your network, your community, maybe running ads. Do those have to happen for crowdfunding success? Is there something else that is like the critical, I feel like, what's like the one magic thing that helps, crowdfunding success?
Yeah, there's probably, I'd say there's two big things that we've actually seen be the make or break of campaigns. While it's certainly nice to have a large community, you don't necessarily have to have a large community. I think that it helps, but it's not a key factor. Like I said, I mean, the two largest raises that we've done were B2B companies. I'd say the two key pieces that we've seen really drive campaign success and are honestly some of the biggest indicators of whether or not a campaign will be successful. First, and this is kind of the obvious one, but it's still something that we see when it's not in place be an issue. When you're working with a platform like SeedInvest or like others, they have a team internally where this is not their first rodeo. We have a team where literally they run campaigns every single day for, day in, day out, year in, year out. So when they make suggestions, hey, you should try this or try that, if they make those suggestions, that's coming from a place of experience. So we find that companies that take those teams' advice tend to have much more successful campaigns than companies that will ignore that advice. So something that's kind of relatively simple. I think the one that's probably a little bit more, maybe not as obvious, but very important. Over the course of a 45 to 60-day campaign, you're essentially building a funnel of investors. So basically, our job at SeedInvest and your job as a founder is to just get people to the profile page. And once they're at that profile page, it's kind of on SeedInvest or whatever platform you're working with to convert those investors. Investors will typically not invest the first day that they take a look at a company. They're going to think about it for a few weeks. It's why the last 2 weeks of an equity crowdfunding campaign are going to be the busiest and frankly the most critical. But something that's very important to converting those investors in that funnel is positive business updates. Every investor wants to invest in a company that they feel like is going places. So if a company over the course of 45 or 60 days is able to come out 2 or 3 times with positive updates, hey, we just got Q3 numbers in, they're 30% over Q2. We just landed this strategic partner. We just got this grant. We just got, added these new customers. Our retention rate is up 10%, whatever that be. Being able to go out to potential investors over that campaign with those updates is critical to having a successful raise. So, we've seen companies that we love, that we're, internally at SeedInvest, we're really passionate about, but the company tells us, yeah, there's really nothing going on in our business for the next 2 months. And we'll tell them, we love you, but this isn't the right path for you right now. Let's talk again when you have those updates kind of loaded up and ready to go.
Yeah, and that's interesting because that's also the same advice I give to founders when they're raising from angels or VCs, right? As you're going through the process, it's really nice to be able to continue to create that momentum by giving out good news updates. Certainly better than bad news updates.
Yes.
So that's really helpful. I guess I want to end with my last question, which is, given the current environment that we're in, where I feel like many VCs are maybe saying they're open for business, but are they really? Angels have definitely pulled back quite a bit. We're hearing that valuations are coming down, round sizes are coming down. How has that affected equity crowdfunding? And is this a better time, worse time? Are those similar trends happening in equity crowdfunding today, given COVID?
Mm-hmm. Yeah, I'd say for the right companies, this is actually one of the best times ever to leverage equity crowdfunding. When this started, when this crisis hit, it was an unknown for us. It was a scary couple of weeks, especially when the public market started taking a downturn, whether or not individual equity crowdfunding investors would be pulling back. What we were very pleasantly, I wouldn't say pleasantly surprised, but very kind of internally excited to see is that we saw the opposite. We saw investors actually investing more capital into companies. A lot of that we think has to do with the fact that the private markets, like startup investments, are a good buffer against the turbulence that we're seeing in the public markets right now. If you invest in a company that's a startup, you're expecting to hold that investment for 4 to 7 years. It's not like you're investing in, a share of Apple and the prices are going up and down in these crazy markets. What I will say, so, taking a look at that Q, this quarter, actually, I believe already Q2 has been the most active quarter that we've ever seen for our investors, and we've still got, a month and a half to go. So that's been very positive. But what I will say is investors are being very thoughtful about where they're putting their capital. So companies right now that are in the med tech space, companies that are direct to consumer, companies that are essentially, kind of COVID proof in certain ways, or companies that are able to essentially, continue to thrive or continue to kind of stay afloat in this current environment. Those companies are doing well. That's where investors really want to allocate their capital. For example, companies in the travel tech space, they're not doing so well right now. They're not able to raise capital. So it's for the right companies. This is a really good time to raise. I will say we have seen valuations come down a little bit. We have seen angels and traditional VCs pulling back. What we see a lot of companies doing right now is opening up bridge rounds. The hope, everybody's hoping that, by the end of the year or early 2021, that things will have rebounded in the more traditional sources of capital. But people are looking, even companies that have a lot of runway are saying, hey, let's get a couple extra months under our belt. Let's get some additional runway so that if things aren't great at the end of the year, we can still weather it out. We can still be in a place where we can continue to grow and stay afloat until capital returns.
So it's interesting that you mentioned bridge rounds. Are those companies that had previously been on the platform and raised equity crowdfunding as part of a previous round, or even new companies are doing bridge rounds, new to the platform?
I'd say it's definitely new companies. We do see a couple of our portfolio companies coming back and doing additional bridge rounds. We have portfolio companies coming back right now and they're doing series rounds, which is interesting in this environment. But I'd say a lot of what we've seen over the past few months is companies that are new to equity crowdfunding. And I think that's because, this is new for everybody. Traditional VC and angels aren't used to jumping on video calls and hashing out diligence purely over email, and kind of, founders aren't used to interfacing with investors solely through digital means. That's something that we've been doing for 7 years. So because it's old hat for us, we're actually seeing a lot of founders that honestly, probably until this year, never thought that they would even consider equity crowdfunding as a potential resource.
Yeah, that's so interesting, actually, and it makes sense. You're already online. It's so much easier. You're not transitioning your whole business the way VCs and angels are. Okay, I want to get to the questions from the group. The first question is from Armin. A regular VC seed round or angel syndicate, in a regular VC round or angel syndicate, you give some control over to the investors. In a crowdfunding campaign, it seems like you don't give any control at all. Is this assumption correct?
So I'd say that you don't give over as much control. And this is actually a reason that we see a lot of more experienced founders, frankly, particularly at the later stage, opting to go the equity crowdfunding route. I know that we've talked a lot about seed stage rounds, but when we look at later stage rounds, oftentimes SeedInvest is taking down almost the entirety of it. And a lot of that comes down to control. So crowd investors, they're not taking board seats. They're not taking full-on inspection rights, assuming that their check size is under a certain threshold. Typically, they will still be granted voting rights. Because it is a little bit still, even though you're giving investors voting rights, it is still a little bit more founder friendly because you don't have one VC that is holding basically the vast majority of that share class. So it is still a much more founder friendly way. And we see companies even that have kind of these mixed rounds where it's VC along with the crowd investors. We see it as a way for them to retain more control of their company and continue to call the shots. And that compounds as you get to Series A, Series B, where instead, where you might have a couple big VCs coming in, and all of them are asking for board seats. When we do a series round, we essentially just want one independent board member representing the entire share class. And oftentimes, crowdfunding platforms will work with the company to identify who that is. Crowdfunding platforms, SeedInvest, we don't take board seats ourselves. That's just not our area of expertise. We really wouldn't be adding too much value there. But if you've identified somebody that is, a strategic professional in your network or someone that you really want on your board because of the value that we're bringing, equity crowdfunding can be an interesting way to be able to have that person be on your board and still not give up too many seats. You can have that person represent that share class. But yeah, when it comes to kind of quarterly reporting, that stuff, kind of that access to general information is typically going to be more or less what you're giving angel investors.
Got it. Thank you. That was very helpful. Second question from Armin. What % of dollars raised would you say is driven by the platform's own community versus the founder community versus going to the public using digital ads or something like that?
Yeah, that is the hardest question to answer. I hate not being able to give a good answer there because it varies really widely. We've had raises where it's almost been 100% driven by the SeedInvest investor community. We have raises that are almost 100% driven by a company's own community, especially as we get to later stage rounds that are looking to do $5 to $20 million of the round via equity crowdfunding. Those campaigns will often be driven mostly by people that are new to both SeedInvest and the company. They're coming in through digital ads or other forms of advertisement. So I know that's kind of a non-answer. What I would say is generally, I'd say for later stage rounds, it's mostly going to be either community or advertising. For seed stage companies, if you're a B2B, it'll probably mostly be driven by the SeedInvest community. If you're B2C with a strong engaged community, it'll probably mostly be driven by your users.
That's really helpful. Thank you. Taylor asks, where are they running ads on the equity crowdfunding platforms, or is this more like a social media and running ads everywhere?
Yeah, it's more like a social media running ads everywhere. We've seen Instagram ads work really well. We've seen LinkedIn convert. We have a lot of companies that like to advertise in the Hustle, which is a newsletter that I'm sure a lot of y'all get. We had one company, and this is more common for the companies that are doing larger rounds. We had one that was running ads on CNBC, which was very interesting to see the ROI on that. When it comes to ads, or how we market to the SeedInvest community, that's SeedInvest job, or whatever platform you're working with. That's really their job. They know their users best. They know the best way to communicate with them. I know what we do at SeedInvest is email. And sometimes old school outreach. If you're a small crowd investor that's only investing $1,000 per company, a targeted email about a company that matches your investment criteria is probably a good way to get in contact, a good way to get them over the finish line. If you're a large angel that's writing 6 or 7 figure checks, that person is going to need somebody to pick up the phone and call them. So depending on who the investor is and depending on the platform, they'll advertise to their user base differently. But that really should be on the platform that you're working with, not necessarily on the founder themselves.
Great, thank you. The next question is from Lane, which is, can you just do your seed round on SeedInvest? Do you have to mix it with a regular fundraise? If you're doing, oops, sorry, I just lost the question. If you're doing a smaller seed raise, then Lane, I'm so sorry, I'm messing up your question. Sorry, do you have to mix it with a regular fundraise if you're doing a smaller seed raise and then later a price round as a regular fundraise? Like, I guess sequentially doing that.
Yeah, so I guess as I understand, I think the question is, can you just run your seed round on SeedInvest and not incorporate any traditional offline fundraising into it?
Yeah.
I would say, it's been done. It can be done. It's very much an outlier. Like I said, 90% of the companies that we work with are doing both online and offline fundraising. I'd say that when we see that work, it's typically going to be companies that have very, very engaged user bases. So it's happened in the past, and there have been a handful of companies that maybe didn't have user bases, but they had some just incredible off the wall crazy traction that allowed them to run basically their entire bridge rounds through SeedInvest. But it's definitely an exception rather than the rule. For better or for worse, the one thing that crowd investors do have in common with VCs is a herd mentality. Nobody likes to be at the party alone. If smaller investors that maybe don't necessarily have the expertise that a more seasoned investor would have, if they see that there's traction from offline angels or offline VCs, or strategic institutional investors, et cetera, it gives them more confidence. So we see those companies raise more capital. So in most cases, I would say if you're only looking to raise online, probably not going to be the best path if you're looking to raise a meaningful amount, but there are always exceptions to the rule.
Great, thank you. The next question is, in your opinion, what's the most common misconception people have about equity crowdfunding?
Most common misconception. I think honestly, it's that it's competitive with VC, or that if you do an equity crowdfunding round, you're not going to be able to land capital from top tier investors. I think and I think probably back when, and certainly when I first got started back in 2014 at SeedInvest, to a certain extent, that was the case. It was very new back then. I think a lot of VCs said, well, how is this going to affect the cap table? Is this going to result in 1 million lawsuits from disgruntled investors? I think a lot of those things, those concerns, over the past 7 years since equity crowdfunding has been around, those concerns have been shown that they're just not true. If you're smart about it, you can have a clean cap table. You don't see small investors, suing the companies that they're investing in. Even when things go wrong, most startups fail. A lot of our portfolio companies have failed. And investors expect that. They know what they're getting into. And I think the other really positive thing that's kind of come out of that track record of equity crowdfunding being a success in the US has been that, initially we first saw companies that were portfolio companies of large funds kind of telling their portfolio companies, yeah, this is an okay option for you to raise your next round. And then we started seeing them saying, hey, actually, you should incorporate equity crowdfunding into the round that we're leading. So it's been really exciting for our community of investors to invest alongside firms like Bessemer and Founders Fund and other kind of tier one firms out there. And oftentimes those are going to be companies that they could close their entire round offline if they wanted to, but they kind of see the value of incorporating equity crowdfunding, and it makes more sense to them, saying, hey, I can just throw in another fund into the mix and kind of get more of the same, or we can mix things up and get a little bit more of a diversified community of investors.
Yeah, that makes sense. Thank you. From Kevin, how much confidential information do you have to advertise on the platform? Revenue, customers, things like that?
Yeah, so it's always a balancing act. So when you have contracts that are under NDA, if you have information that's incredibly sensitive, where if it gets out, it could cause material damage to your company, then you shouldn't be advertising it. That being said, the more information and the more transparency and the more things that you can provide to investors, the better. So if you're going out to crowd investors, you do need to provide at least the past 2 years of your financials reviewed. It's a high-level snapshot. It's just kind of hey, here's our balance sheet for all of fiscal year 2019. Here's our, income statement for all of 2019. Here's our cash flow statement for all of 2019. So you are providing, heightened levels of disclosure that are out there publicly. So what we kind of tell companies to do is, hey, if you have, if releasing this data is going to kind of tank your company, then you probably shouldn't go down this route. Frankly, we like to invest in companies where if they release all that data, they have, a strong enough moat that it doesn't matter if a competitor knows, hey, our cost of acquisition is $15, or it doesn't matter if their competitor knows this is our retention rate, or this is the pipeline that we're looking at. And, that pipeline might be like, hey, we're working with a tier one, car OEM. You might not necessarily, say who that person exactly is. But we find that companies that have kind of strong defensible business models and solid underlying kind of, company soundness are able to put this out there in the public. And it's, in a lot of ways, it's almost kind of like kind of like an FU to your competitors. Like, hey, we're willing to put all this stuff out there, but we're still going to make it, and we don't care if you know. I think I'd say where there is an exception to that rule, where we have seen companies be able to kind of put almost nothing out there and kind of keep things a little bit more closer. It's going to be companies that are in defense. So we've worked with companies where, they haven't been able to put out a lot of information because, they might have the DoD as their customer. There might be, we've worked with rocket ship companies. There's national security things that are involved when you're dealing with, you're essentially building a bomb that you're exploding and shooting it off into space. So I think that when it comes to those companies where there's honestly security concerns, those companies can get away with disclosing, a lot less than others.
Yeah, that makes sense. Thank you. Let's see. This is a question from AH. Can you elaborate on the SEC changes that were enacted in March? Please clarify the impact for investors, especially non-accredited investors.
Yeah, so going over the, and apologies if I missed some of them. I've read through everything that our attorneys have sent through, but I'm not a lawyer, so take all of this with a grain of salt. So back in March, the SEC basically announced a set of changes to the crowdfunding regulations to make things basically easier. The largest one, and those changes will probably be going into effect, I think in Q3 or Q4 this year. So they announced the changes, there's a comment period, and then the changes will go live. The biggest one, from my perspective, there's a couple big ones. First, it raised the amount of capital that companies can raise under the crowdfunding exemptions that allow for non-accredited investors. Previously, you could only raise, if you're a seed stage company, previously you could only raise $1 million from non-accredited investors as part of your overall round. They're raising that limit, I believe, now to 5 million, which is going to make equity crowdfunding a lot more manageable for kind of seed and Series A companies as well. They'll be able to raise more capital of their rounds through the crowd. The other large kind of consideration was the ability to use SPVs. So historically, the only way you could get a one line item cap table solution was a trust. Now you can leverage an SPV. So we'll see to what extent, crowdfunding companies choose the SPV framework over the trust framework. I know it's something that we're looking at right now and kind of considering. So TBD on the impact that'll have. So I think those are probably the two biggest changes. I know the ones that most resonated with us internally. I know there was a few others, and apologies for not knowing them off the top of my head.
And just to clarify, an SPV is a special purpose vehicle.
Yes.
Got it.
Yeah. Essentially, it's basically like you're running up an LLC. I believe the investors are technically investing in that LLC, and then that LLC will invest in the startup. So it's kind of like a 1 degree of separation.
Got it. I think that's all the questions in the chat. If we have a few more minutes, if anybody would like to add a question, but in the meantime, let me kind of get to one of my questions that we didn't get to, which is kind of a lot of the founders on this call are kind of pre-seed, right? So they're a little early for equity crowdfunding from the way you've described it. But what's kind of the one kind of piece of advice you would give them so that when they do get to a seed round, that they're kind of really set up to be successful at equity crowdfunding?
Yeah, I mean, I think the advice that I would give them, and I think this probably goes, whether or not you're looking to do an equity crowdfunding round, but I know this is something that, particularly in today's environment, is important. I think more so than ever, certainly more so than in the past 10 years. I think investors and equity crowdfunding investors, potentially even more so, because equity crowdfunding investors are, based on their backgrounds, they're a little bit closer to real life. They don't all live in Silicon Valley in big houses and in Malibu. They're real people. They're small business owners. They're people on Main Street. So because of that, I think that having strong underlying fundamentals and really focusing and spending your time on that is important. I think at least for the foreseeable future, the model of kind of, hey, let's just grow, and we'll worry about reaching profitability, or not reaching profitability, but we'll worry about building a path towards profitability in the future. Those days are done, at least for the foreseeable future. So I would say really focus on getting the underlying fundamentals of your business right, especially if you're pre-seed and looking to gear up for a seed round. I think that more so than ever, investors are going to be looking and saying, all right, if we give this company $1 million, can they put it to work right away? Do they have those acquisition channels lined up? Do they have, positive unit economics? I'd say, that's probably the most important thing for equity crowdfunding, as well as normal raise seed rounds, is just building out a more fundamentally stable business with a stronger path forward. A hockey stick growth, doesn't mean anything if you're losing money constantly and, there's no end in sight to those losses.
Yeah, I couldn't agree more with all of that. So thanks for that. And we did get one more question, which is, where's the best place to get resources? Where's the best place to get a sense of resources for how we should be preparing now to put us in a good position to pursue equity crowdfunding down the road? Do you have resources on your site?
Yeah, so I'd say shameless plug for our website. We have two portions of it that I think would be useful. We have something called the Academy. If you scroll down to the bottom of the website, I think there's a link to it. That has a lot of guides, a lot of them specific to equity crowdfunding, a lot of them not specific to equity crowdfunding, and just more about raising capital in general. That's a really strong resource. A lot of stuff about kind of the different security exemptions and the legal stuff. A lot of information about offering documents, which is always something that is a little bit scary the first time that you're going through. So I'd recommend that. Our blog is also really good, and especially the last several months. I know we've been pumping out a lot more good content. So those are two resources that I would recommend on SeedInvest. I would also recommend, I think I said this earlier, there's a law firm called CrowdCheck. They are probably the foremost law firm when it comes to these equity crowdfunding regulations. Sarah Hanks over there, who runs that firm, is an absolute rock star when it comes to this. And I know we've collaborated a lot with them in the past on creating different content and education material. So those are probably the two, I think, most comprehensive places where you can find collateral around equity crowdfunding.
Great. Thank you. I think that is the end of the questions that we have. So Nico, I just wanted to say thank you. This was so helpful. I learned a lot today. I hope the audience did as well. I'm sure they did. Really appreciate your time. And thank you all for those who are listening and still on the call. We'll have another RetailX session next week on building teams and managing freelancers and remote workers. And then on June 4th, we'll have one about early stage customer acquisition, particularly using Kickstarter and other means. So I look forward to seeing everyone there. Thanks again, Nico. I really appreciated this.
Thank you so much for having me. And if anybody wants to chat any further, even if you're pre-seed and not thinking about doing equity crowdfunding anytime soon, feel free to shoot me an email. I'm Nicholas without an H at SeedInvest.com. More than happy to chat further. This is what I live and breathe. So more than happy to talk about it.
Thank you for sharing your email. You know what, I'm going to put it in the chat as well. Yeah, that is really helpful. And I'm sure if people will be reaching out at some point to you. So you might, hopefully you don't get barraged.
Not at all.
Great. Well, thanks again and have a great day, everyone.
Thank you so much. Bye, y'all.
Bye.